Good morning, good afternoon, good evening, wherever you are in the world. Hello, for those that haven't met me before, I am Mark McAllister. I'm the senior partner here for Holborn, based in Cape Town. Today, we're going to be discussing the interesting subject of cross-border taxation and working remotely, particularly for those that are connected to the UK, but other jurisdictions once they normally move back to South Africa or potentially as a digital nomad. Here are all my contact details. Feel free to follow us on social channels or reach out to us on any of the details that you see below. If you'd like to have all of my contact details in one easy format, just scan this QR code now and it will save the contact details to your phone. Okay, if you have any questions, please don't hesitate to ask them as we go along. There's a bottom at the center of the screen. A button at the center of the screen which allows you to ask questions, and we'll do our best to answer them all at the end. So don't hesitate to ask as we go along. So let me start off a little bit about us and who are Holborn. So we've been around for over 25 years now. We've got about $3 billion that we manage across the globe for various different clients in 30 different countries. We've got offices in over 11 different countries, over several regions of the business. Several thousand happy client reviews on Trustpilot, so feel free to check us out there as well. So who is this webinar for? Well, ask yourself the question, are you currently abroad but thinking about coming back to South Africa soon? Do you plan to carry on working for your employer remotely when you come back to South Africa? You're not sure if you can still be employed or not. Are you thinking about things like a subcontracting or a self-employed arrangement? And do you want to protect your foreign earnings and legally mitigate your taxation? And are you aware of the legislation you should be thinking about? If you think any of those points are relevant to you, then this is the webinar for you. What questions do we often hear? Well, this is the sort of FAQ on this subject. So the first one, what is a dual tax agreement? I often get people asking, what does that mean? You know, how do I live in South Africa, work remotely, you know, for a company online or as a digital nomad? It's all the rage these days. Well, maybe not as much as it was during COVID, but yeah, working remotely is much more common these days. Who is my tax liable to and when? You know, that's a fantastic question. Again, a lot of these questions come down to, sorry, that standard caveat in our industry, it depends, but we'll try and narrow the it depends down. So you've got a little bit more of an idea of what might potentially apply in your situation. What are the implications for your employer if you decide to go back to South Africa and carry on working remotely? And this is, again, one of the most common things we see. Should I think about setting up a company and becoming an independent contractor? And if so, where? And are you aware of the implications of doing that in a foreign jurisdiction when you come back to South Africa? And something that's becoming increasingly popular these days, can a foreign agency agreement work perfectly for you to meet all of your needs and that of your employer as well? And then linked with all of that, ultimately, how do you plan for your future? You know, we've only got a certain amount of time on this earth, and how do you make sure that you are thinking about that future when you do eventually stop working, so that you're able to provide for yourself and your family at that point in your life? So let's start off first of all with a dual tax agreement. So what is a dual tax agreement? Well, essentially what it means is that you shouldn't pay tax twice, but you do still owe a government for your tax. Which side of the line are you on? Well, that's something that is a question, and we'll try and answer in a bit, or at least give you some very vague guidance, as clear as we can make it anyway. One thing to be aware of, though, is common reporting standards. And I put this in there because quite often I come across potential clients who are quite blasé, you know, about the tax man. You know, what are they going to do? How do they know? Well, we're entering the age of artificial intelligence, big data, and all you have to do is Google common reporting standards to see how good government agencies are at sharing data. So if you think just because you've got an offshore account somewhere and all your money's flowing through there that you don't need to report to a tax man, and yet you're living in South Africa, you know, those days are long, long behind us. And our advice is always to consider regularizing your affairs or normalizing your affairs with the tax man. It's not something that you should mess about with. But actually, the good news is that South Africa is currently, and I'll talk about some of the recent changes or potential changes, it's currently one of the most tax efficient jurisdictions for pensioners. So for people that have lived and worked abroad, this is where the dual tax agreement really works for you. So that's the headline points on a dual tax agreement. And obviously, there are lots of these agreements between all the different countries in the world. The most relevant ones, if you're coming back to South Africa, though, are the dual tax agreements between South Africa and the country that you were in previously or are currently in now when you're thinking of moving back. So how do you live in South Africa and work remotely for an overseas employer? Well, first of all, operationally, it's easy, relatively speaking, right? If you've got a willing employer that's happy for you to be on screen like we are now, post-COVID, the rise of Zoom, Teams, etc., really started people thinking about this. The high cost of living in the UK, particularly, has been reported for a number of years. So why not do the same work, but potentially, live and have a cost base in need to have a cost base that's lower in South Africa. Run your life like a business. So one of the things that I often say to clients is, if you have a business, what we look at is your revenue that comes in. Okay, so your sales, if you were, your costs. So what are you spending to live? That might be your rent, that might be mortgage, that might be car, school, you name it. And if you were running a business, what would people tell you? Well, they'd often say, drive as much revenue as possible and cut costs as much as possible, and the bottom line will look after itself. So the move back to South Africa is a very tempting one because of that lower cost base in dollars, pounds, euro terms, and potentially, if you're structured correctly, you might be able to have a higher income post-tax than you're used to, for example, in the UK. But there are pros and cons to both routes that you need to think about. So how do you do it when you come back? Well, there's a number of different routes, or the main two, firstly, to think about is, are you going to do it as an independent contractor or an agent, an agency arrangement, something along those kind of lines, or are you going to try and stay employed in the traditional sense of the word? Those really are the two headline routes that most people are thinking about. So if you go as an employee, it's staying on the UK payroll an option. What stops this, and after how long? What about pension benefits, etc.? Does anyone really know? All these questions, like, for example, labour law implications for a foreign employer, we're going to try and answer now. Likewise, an independent contract, the questions that often get asked is, will your company accept invoices for your services? Do you wish to work for more than one employer remotely? You might be working for a number of clients and you want to get paid perhaps in multiple currencies as well. So that's the kind of background that you need to think about. But when it comes to taxation, you do have to pay tax to at least an authority that you're liable to. You can't pick and mix. I often see clients thinking, well, that bit of income tax legislation in South Africa works for me, but I kind of like this bit in the UK. You can't pick and choose. You have to pay the relevant tax that is applicable in your situation. And this is where, unfortunately, we start to go down that it depends situation. So if you are a non-South African citizen, so you're a Brit like me that's moved down here as an example, physical presence is the most important primary decider for people like us. Just to be clear, if you're a South African citizen that's moving back, there's another thing that sort of trumps this that I'll come on to in a second. So if you're a foreign citizen, the three main things you need to be aware of that SARS looks at is, have you been in South Africa for at least 91 days in the current year of assessment, at least 91 days aggregate each year over those 5 years, so that's about 3 months, okay, and then lastly, 915 days, so that's within 3 years if you've been here full time. 950 days can add up pretty quickly in the last 5 years. And if you tick all three, then as a foreigner, you would then be deemed a South African tax resident. Just to be clear, your visa is irrelevant. I often get a lot of people say, well, I haven't got permanent residency, or, I'm just here on a retirement visa. Forget about visas. You can be here as an illegal immigrant and you are still liable for taxation if you are meeting these tests. And don't forget, as a South African tax resident, tax is liable on your worldwide assets and income. If you're a South African citizen that's maybe been abroad for a while and come back, the other test that's more important for you is what is deemed ordinarily resident. It's very woolly, hard to define. It says in legislation, if you return back to South Africa after your international wanderings. So potentially you could be deemed South African tax resident quicker than you think. You might think you've got 5 years, and actually, if you were born a South African, raised as a South African, went abroad to the UK in the 2000s, and now are thinking to come back. If you sell everything up and move back, you might be tax resident, sooner than you think. So that's where we say, always get advice, professional advice, get a tax opinion, so that you know rather than you guess. And that's our common message throughout all of this that we're doing today. Okay, so now that we've touched on that, let's talk through how to structure your employment or billing, just so you're aware of the options and what most people think about. So what we try to do is keep this as simple as possible. So let's start off with that employed situation. So you've agreed that you're going to stay employed somehow through a UK company or potentially employed by a South African subsidiary. You'll be used to this if you're an employee. PAYE gets deducted as normal for that jurisdiction. And that's where we potentially have a mismatch between the rules in the UK and the rules in South Africa. So if you just move back and nobody really knows that you moved back, you're still on the payroll in the UK, just be aware that you might end up creating a small liability to SARS, and also potentially run the risk of your company having some issues as well. So I wouldn't rely on employed PAYE as a stable route for definite, particularly if there's a UK company that you're working for. Coming back and working for a South African subsidiary is pretty straightforward. The downside to that quite often, though, is people find that they'll be offered a lower salary linked to the sort of market rate in South Africa. So that's the sort of employed route. That's relatively simple to understand. Next, we go across this dotted line, and this is where we get into sort of the very loosely termed self-employed stroke contracting world. So this is where you're no longer an employee as such. And if you do it personally, so you're raising invoices to an employer or ex-employer or a client, if we could call them that going forward, you might do that out of your UK, as a UK resident, or you might do it as a South African resident and reporting to SARS, okay? Bottom line is that the tax must be declared and paid by the employee. Nobody's going to deduct PAYE for you. You'll get paid full amount gross, but your income will be covered by the dual tax agreement. And I've seen this a few times before. There is a high risk of this going wrong because people put money to side or not enough money to aside, or worse, no money aside. They just spend it all and suddenly they get a big tax bill from a revenue authority either side of the water. So be really, really careful if you're thinking about going over this line into those scenarios. The next route is where people go, okay, look, I want to become a contractor. I'm going to set up a company, or I've got an existing company in the UK. Great. That's what I'm going to go and do, and I'm going to raise invoices out of that. Lovely. And again, that seems fine on the face of it. And if you do that, the company will raise the invoice, and the tax must be declared and paid for by the company. Normally, that's in the form of corporation tax and in the company in either the UK or South Africa. But then, if you want to get money out of it, then you often issue a dividend. And the rules are very different between the UK and South Africa. And again, you run the risk of a significant liability building up, particularly if it's what we call a controlled foreign corporation and the place of effective management, POEM, is in South Africa and you're deemed South African tax resident. So again, I always urge, take time to take proper advice if you're going to think about incorporating a company overseas, and we'll come on to that in a minute, or carrying on using your old UK company when you come back to South Africa. It's really important you understand the risks associated with that route and how long that may be optimal and at what point it may become suboptimal. The last option is one that a lot of people may not have heard of or may not be aware that it's even available to them, and that's the use of an offshore agency. So we've seen this now become increasingly popular for clients working abroad in South Africa for and working effectively on a contract basis or multiple clients, what they'll do is effectively have an agency that then bills for their time, and it allows them to do that easily cross-border in multiple currencies. So it's a fantastic solution, and the tax can be handled by that agency on any salary payments. So you still have a PAYE element to it, so you're employed in South Africa for that agency, and it just potentially opens up the door for a more efficient use of dividends, and the liability therefore to SARS is significantly less. So long story short, in all of those situations, I would just be aware of, that these different routes can potentially have, liabilities to a taxman. So if in doubt, take advice, just run it past us and we'll sit down and we'll talk you through what we think is the situation, give you a bit of a heads up. And if you need a formal opinion, that's where we can bring in the tax consultants that we regularly use, who charge by the hour or on more substantial amount. So it's always good to talk to us first of all, just to get a sort of general overview in your specific situation. Okay, so this is one of the other things, again, I'm doing this more from a UK perspective because a lot of people on the call will have a UK connection. So if you're declaring income in the traditional sense of the word, and you're employed and doing pay as you earn, the income tax tables are different between the two countries. And that's where potentially a mismatch can happen. So you can see here, the UK, most people are aware of the 12,570 personal allowance limit. It's not the same in South Africa. And actually, with the rand so weak, what you'll find is that you will go up the bands into a much higher tax bracket quicker in South Africa than you potentially would do in the UK. And this is the bit where I talk about you can't pick and mix. You can't hang on to the personal allowance because it suits you, and turn a blind eye to the fact that as a South African tax resident, you might owe SARS for 18% on that amount. So again, if you think you fall into that category, talk to us, and if we think that there's a risk, we'll help refer you to a tax consultant that can give you a formal opinion and then help to sort that out. If you go down the self-employed contractor route, again, the same principles apply. The tax tables are the same, but the onus is on you as the taxpayer to make sure you pay the correct amount of tax to the correct authority. And so if you pay money to HMRC, great, it's fine to a certain extent. But if you owe money to SARS, you will have to offset that maybe using the dual tax agreement, but there could still be a liability. So worst case scenario is paying nobody any tax. Second worst case scenario is paying the wrong amount of tax to the wrong authority and then having to sort it all out, potentially, with penalties and interest associated with it. So if in doubt, have a conversation and try and narrow it down to something that's a little bit more defined, let's put it that way. Okay, moving on from there. So again, a lot of people go, oh, that sounds quite complicated. I'm just going to pop up a company somewhere, and where would I go and do that? Well, there's lots of different countries around the world, but one of the things that you need to be aware of particularly is the risks of having, say, for example, a UK company and then trying to run that as a 100% shareholder from South Africa. We see that quite common. We also see people using, for example, the Isle of Man. It has a much lower corporation tax rate. But at the end of the day, we've got to be aware that what you do should be primarily for fundamental substance reasons that are different to just saving tax. Otherwise, you run the risk of falling foul of the authorities. I don't think anyone can argue that the UK is a better jurisdiction to do business than South Africa. Just looking at exchange control as an example, you can move money in and out of the UK so easily. With the latest online platforms, the likes of Revolut and Monzo, it's so easy to do business globally. Try and do the same thing in South Africa, and I've seen sadly countless examples where money's got stuck, it won't clear. It's a bit of a nightmare. And then Mauritius, also a great jurisdiction, but you need to be aware of that. You need to be using these kind of business locations for the correct reasons, not just trying to pay a lower tax rate. And why do I say that? Well, because if you are deemed to control these companies from South Africa, then SARS has the ability to tax you as an individual, as a South African tax resident, regardless of where the company is, and you will be personally liable for the difference. So again, please don't put your head in the sand and assume just because I've got a UK company that I use for my consultant business for the last 10 years in the UK, I'm going to move back to South Africa, carry on raising invoices, and live in South Africa as a South African tax resident, that a number of years is going to go past and it's not potentially going to be a problem for you. Just be aware, and if you think that might apply to you, if you're not sure, if there's even the slightest nagging doubt, speak to a professional and understand the importance of POEM, the place of effective management, and CFC, the control of foreign companies legislation here in South Africa. Last little bit to touch on, because again, a lot of people aren't aware of these kind of solutions. They're very, very misunderstood, I think, and not widely discussed, is where a foreign agency can help work through all of these issues in a neat solution. So, let's say you're working for a client in the UK or Europe or US, and you want to raise invoices for your consulting services, online tech services, whatever it may be. Rather than incorporate, you can be employed by the agency, and the agency will raise those invoices to your client, and you're working on a back-to-back agreement. The client will pay in whatever currency that you're billing them to into an agency, okay? And then what we would encourage you to do is have a suitable salary arrangement in place with the agency that you negotiate with them, and that is that purple line you can see in front of you. So whatever income comes down to you as a salary, it's fully taxable, as it should be. But potentially, if you have an amount that's left over, then this could be used in what's called a salary sacrifice share scheme arrangement, and therefore that can be used to then fund an offshore structure for your future self. And that's ultimately where we come in, is that those funds can be then used to invest for your retirement, so that you're not a burden on the state, that you don't want to have to rely on state handouts. And potentially that might also involve a 0% dividend into South Africa. And that's what those green lines are there. So again, if you haven't looked at an agency or not sure whether that might potentially apply to you or not, again, have a conversation with us and we can just give you a rough idea whether this is something you should be considering, or whether actually it won't even work for you in the slightest, and look at alternatives. Please don't get too hung up on the little bit in the bottom right hand corner there, section 1010. The 183 days piece. That's really aimed at people that are coming in and out of the country on a regular basis. We've got a lot of people that do this, rotational work, as we call it. Again, if you're using an agency, all it means is that you can earn 1.25 million rand, which when this was first put in place was $90,000. It's now closer to $60,000 a year, and in theory, you can earn that tax-free if you're more than 6 months out of South Africa as an ordinary resident. So that doesn't apply to lots of people, but again, we can give you an idea on that. But still, the principle of using an agency in those kind of industries can make a lot of sense, particularly if you're working for multiple different entities, multiple clients, etc. So talk to us if you think that that might be of use to you. Last few little bits, and again, I put this in there because it comes up quite often in the frequently asked questions. Workplace UK pensions should only be contributed to when you are physically present in the UK to achieve UK tax relief. Once you are no longer physically present, the maximum you can put in each year is £3,600. Okay, so this is one of those little operational mismatches between, in the old days where there was really no computers or technology that allowed you to come and live in another country and still work, this wouldn't have even been an issue. But with the rise of Zoom and Teams, what it's allowed you to do is exactly this. But the regulations state that you can only claim that UK tax relief on pension contributions if you are physically present and resident in the UK. So that's often where these things start to go wrong. So if you're a digital nomad, you may try and remain on the UK payroll for a period of time. But just be aware that you are potentially not following the letter of the law, and that might cause you a problem. It might suddenly pop up with an HR issue, and then all of a sudden the whole situation comes on top very quickly. So just be aware of that's something that we have seen a few times now starting to be an issue. One other thing, and this is one thing that's a very hot topic of discussion at the moment. Currently, there's this brilliant exemption where you can go work in the UK for 20, 30 years, accumulate a foreign pension, and then when you draw it over the age of 55 in South Africa, all of that would be income tax free as a South African tax resident if you meet the exemption requirements under what's called Section 101 GC-2 of the Income Tax Act. If you mix this with employment contributions whilst you're physically present in South Africa, you can lose that, and that would be a sad thing to lose, and it can be a challenge if that happens. So again, if you're in that situation, please talk to us. But the message on me, and I've done a separate few webinars on this as well, this legislation is under review. It's been in place for like 25 years. We always knew there'd be a day where potentially SARS would look at this, and it was mentioned in the budget for the first time. We think there's still another at least a year or so before any changes are made, but it is under review, and it's likely that it will go at some point. So if you're over the age of 55, there is a D-Day approaching. I don't know if it's a year away, 2 years away, 10 years away, or never, but there is a D-Day potentially approaching. So again, if you're over the age of 55 and you've got UK private pensions, talk to us urgently so we can walk you through what it would mean to leave those in place beyond that D-Day, whenever it may come. The potential penalty might be up to a 45% income tax charge that you simply don't have to pay. So, this is where prudent financial planning is very important. And that brings me on nicely to the last bit, which is, look, regardless of all of this now, about where you are in your working life, I'm regularly mentioned to my entrepreneurial clients, my digital nomads, etc. They're normally very, very busy worker bees, doing their bit for their clients and what have you. Don't forget about yourself. How much have you actually put away for the future? When you stop working, have you got 20 times what your annual salary is locked away somewhere so you can stop working? And most people look at me quite blankly at that point. The answer is often no, because you worked as a contractor, you've earned a bit more than most people, but you haven't really thought about planning. You've probably spent it, and that's okay. You're not alone, but don't bury your head in the sand and think it's not going to go away. So if that's you, again, talk to us, because some of the things that you need to be thinking about is how to plan for your future. And that might be some kind of foreign, outside of South Africa, pension or trust vehicle that we can use that allows very tax efficient withdrawals into South Africa in the future with a full range of global investments. But again, it's very much a bespoke planning discussion, and we need to know whether this might work for you. It might not. Okay, so if you're sat there going, yeah, this guy's right, I've not thought about the future beyond my 40s, my 50s, my 60s, and I'm worried, you're not alone. Okay, we have these conversations day in, day out. Please come and talk to us, and we'll talk you through what you should be thinking about. And the good thing about working with several hundred expats in your exact situation is we'll tell you what we've seen that works well, but also we'll give you examples of what happens if you ignore it. And it's best to do something about it. There's a great Indian proverb which says, the best time to start saving was 20 years ago. The next best time is today. And again, why do we recommend these kind of solutions? Well, because if you go for a South African solution, they're quite often restricted, whereas the global equivalents aren't. You don't get forced into a South African insurance-based solution. You've got a full range of global options to consider. And then the big one, really, we all know that the rand will continue to depreciate. When I first moved here, it was 15.45, and now here we are at 24.25. I'll be doing this same discussion 10 years in the future, and it'll probably be at 50 odd. It's one thing you can rely on, that the rand will continue to depreciate. And the reason being, quite simply, ask yourself the question, look at the last 10 years in South Africa. Do you think things are going to get massively better in South Africa? Do you think it's going to be about the same, or do you think it's going to get massively worse? And if the answer is it's probably going to be about the same, well, then you can apply the last 10 years of currency depreciation as a guide, and that's how I kind of get to these numbers. And people often think that I'm nuts when I say about that. Well, I remember when it was 10 to the pound when I was here to watch the World Cup, and here we are, like I said, 2025. It's like a boiling frog problem. So one of the best ways to protect yourself against rand depreciation is just don't own rands. Own pounds, dollars, euros, Bitcoin potentially, even something that is not linked to the policies of the country and the emerging market issues associated with inflation in the country. And lastly, one of the great ways to protect yourself is property investment. I've done numerous webinars on the advantages of buying investment property. I'm a landlord. I've been landlords both commercial and residential properties historically. I always encourage people to think about buying property, particularly in the UK, because it is an asset class in its own right, that's worth looking at. You can leverage it, you can borrow money against it, the tenants can pay it off for you. And I'm yet to meet anyone over the several thousand conversations we've had over the years where someone's bought a property and then in South Africa and was able to sell it for more in sterling terms 5 years later. By the time you get to 10 years, it gets really bad. 15 years, 20 years, it gets worse and worse and worse. So when I do finally find someone that's made money in pound terms, not rand terms, pound terms, on a property sale in South Africa, I'll happily talk about it. So that's why I'm always advocating, retain UK property, rent it out, maybe look at acquiring more, and we'll show you how you can do that from South Africa as well, including things like buy-to-let mortgages and other things to think about. So all of these kind of things are what you should be thinking about to protect your wealth. Buy hard assets that grow in proper currency and are able to provide for you into the future. Okay, ladies and gentlemen, I'm conscious that was a very quick whip through. These things often are. There's not so much that we can add to that from a depth perspective because everyone's situation is different. So if any of those things seemed like it would be of use to you to talk about some more, we will do our best to answer the questions now. So please ask those questions if you haven't already. Feel free to drop us a WhatsApp or to connect with us on the socials. And there's all my details there. Or scan the QR code and you can talk to us now online. So we've got a few questions. So let me just stop sharing and we can go on to those now. We'll do our best to try and answer those. Okay, so first question, does the review on the tax exemption apply to UK state pensions or only workplace pensions? Okay, so it's an interesting question, this one. It's hard to answer because we still haven't really had anything from government that's giving us clarity on what they're looking at. All it says is that they're going to review it in this budgetary cycle. So unfortunately, we are shooting in the dark. So I can't answer that at the moment. But if you are working with us, if you're a client of ours, as soon as we know, we will communicate that immediately to all of the people that we think might be impacted on that. So I work on a principle that it's better to prior planning and preparation prevents poor performance. For those that maybe know that expression. So plan in advance. Those that fail to plan to fail is another great one. So hopefully, sorry that anonymous attendee, hopefully that answers your question. And there will be follow-ups in this format where we will give as much information as we can when it becomes available. Okay, so Paul, thank you for your question. So would you encourage someone coming from the UK to rent locally in South Africa and own in the UK when it comes to property? Oh, so this is a great question, right? So when you sit with a planner like me, someone that's truly a financial planner, not a product pusher, okay, there's going to be a number of things that we discussed in a holistic manner. So personally, I always encourage clients to own their own main residence, okay? Why? Because you want to get to a point where your home is your castle, there's no debt on it, you can go and hang a picture up anywhere that you want, and you're not beholden to anyone. That is true financial freedom. That's what we're talking about here. But from a pure investment case perspective, okay, if you buy a property in South Africa, statistically speaking, unless you bought it significantly undervalued, I am quietly confident that after 5 years, certainly after 10 years, I'm talking 99 times out of 100, you won't be able to afford to buy back what you sold in the UK, because the UK property market will keep moving in sterling and the rand property market will keep moving. But also you've got that rand depreciation happening at exactly the same time. So again, it's a case by case basis, but no, I wouldn't encourage people to just rent locally in South Africa, because I don't think that fits with most people's plans. However, in some very few cases, it might make sense. But if what I often come across is people selling the property in Wimbledon, South, Putney Rains Park, where nearly everyone seems to have transited through at some point. There's nearly always a Southwest 19 postcode involved, somewhere in the clients that we work with. And you're selling that house for 800,000, £1 million. It's really tempting to go and buy a 20, 30 million rand property, debt free, and that's normally in camp space, something like that. Like, yeah, that's a great choice, but actually, quite often, 5, 10 years later, we suddenly realise actually the better investment choice was to keep something in the UK. So somewhere between the two quite often is the answer, but it's hard for me to answer that, Paul, without doing the holistic fact-find discussion. That's what my team and I will do, and talk through all these options so you know what's the right in your specific case. Hopefully that helps answer your question. What about buying property in South Africa to live in there? Which is one of the ways you get better standard of living? Yeah, look, again, I think I've just covered that. Again, I own property in South Africa. It's part of the reason we moved here as a family, right? But I've retained UK investment property. I'm looking to acquire more investment property in the UK because the market's dipping a little bit up there at the moment. Why? Well, let's look at the two jurisdictions. About the same population in both countries, 60-ish odd million people. But the UK is the size of the Western Cape, right? So you imagine you took everyone in South Africa and you crammed them into the Western Cape. What would happen to property prices then? Well, they'd go up a lot more, okay? So the problem is that you've got a wider amount of people spread over a bigger area. On top of that, what you've got is, generally speaking, a higher level of earnings across the UK, generally speaking, a higher level of education, and as a result, the demand for property is significantly higher in the UK, and the affordability is more achievable for the average person overall. So that's what creates the demand. Your property growth isn't driven by anything other than willing buyer, willing seller. If you run out of willing buyers, the property price goes down until there is someone that's prepared to pay money for it. And that's why the UK market has been so solid for so long. I mean, out of the last 50 years, I think it's only been negative in 3 of those years. So 47 out of 50 years, it's gone up in sterling terms. And the other thing about it that a lot of people miss when it comes to property investment is, it's really important to look at leveraging of investment property, right? If you go to the bank and say, look, I want to buy some Tesla shares, they'll laugh you out the door if you want to borrow money to do that. But you say, I want to go and buy an investment property in Birmingham or Manchester, they welcome you in with open arms and they will loan you, 60, 70% of the value. I'm not saying that that's a wise choice in the current market conditions around interest rates right now. And again, this is something we would talk about on a one-on-one basis. But buying investment property using OPM, other people's money, is something that was made very famous by the book Rich Dad, Poor Dad by Robert Kiyosaki. That principle of leveraged property is a good way to achieve capital growth. So again, if you're going to leverage property, you need to understand the importance of leveraging, the cost of leveraging, and the currency that you're leveraging in the long term. And my general experience has been people that hang on to and invest in UK property, their general experience is far better in the longer term than owning South African-based rand properties. But there's always exceptions both sides of the water as well. So hopefully that answers your question there. Okay, this question from Duncan. Thank you, Duncan. Is there a limit to the amount of pension income that we can take into South Africa from a UK SIP? In a short answer, no. Okay, so for those that don't know what Duncan's asking, I'll try and give a bit of background. So if you have a money purchase scheme, so this is a defined contribution scheme or a self-invested personal pension, a UK SIP. Okay, so you've normally worked in the UK, for an employer, and it's built up over time. Just to be clear, we're not talking about defined benefits. That's a different discussion entirely. Just going to try and focus on defined contribution. That pot of money, let's say it's worth £300,000-400,000 as an example. Once you hit minimum pension access age, which currently in the UK is 55, you can first of all take a pension commencement lump sum. Okay, so 25% of that can be taken out, and as a South African tax resident, that is tax-free, like it would be if you were in the UK. The key difference is, though, when you come to take the bit that's left, the 75% of the pot that's left over, there's three main options about what you can do there. Again, I don't want to get into too much detail there, but let's just say you draw down that chunk, okay, bit by bit. If you did a drawdown in the UK, as a UK tax resident, you would pay income tax on the UK income tax tables. If you're a South African tax resident, there's a little bit of work that needs to be done between South African Revenue Service, SARS, and HMRC, and your pension provider. And again, we have lots of experience around doing this. We've done it for hundreds of clients. It allows you then to pay out income, and that income is 0% in South Africa. There's no income tax on it. It's exempt. And the total amount is exempt. So in theory, yes, Duncan, if that full £400,000 balance was left, in theory, you could pay it out as one income payment, and that would currently be exempt of any form of income tax in South Africa. And I say currently because, again, something that I've been warning extensively on, we've done webinars on this, is that rule will be changing soon. Okay, so if you are over the age of 55, or even if you're 54, I would say, please talk to us as a matter of urgency if you have UK private pensions, and so that you can fully understand what will happen in your case if you don't do anything before whenever that D-Day will be. We don't know when D-Day is going to be, and it might not happen. It would be amazing if South Africa came to their senses and realised how many expats move to South Africa to take advantage of this exemption and spend all of that money in South Africa and help drive the economy and its growth. I think it's really short-sighted of them to be looking at this as a revenue raiser. I think it will backfire in the long term. No different to the UK, the amount of millionaires that have been seen leaving as a result of Labour's tax changes to the likes of Dubai and what have you. So hopefully, Duncan, that answers your question. So if you're over the age of 55, you've got an opportunity that we hope will be in place for a number of years yet, but potentially that window might close in the next year or two. It might be sooner, but we think it's at least a year or so away, but it might not come. But if in doubt, if that applies to you, please talk to us. Please have a discussion with my team and I, and we'll at least just give you an impartial view so you know what your options are. You don't need to do anything, but you just be aware of those points. Okay, hopefully, Duncan, that answers your question. Okay, if there's any more questions, please ask them now. If not, I'm going to wrap it up there. We're just coming out to the 45-minute mark, and I'm trying to keep these things to that time frame rather than you listening to my dulcet tones all afternoon or all evening. So I'll just share our contact details one last time. So if you've got any questions that we haven't answered or you specifically want to know about, please just drop us an email or send us a WhatsApp. And let me just do that. There we go. Or pop in and see us. We've got 3 offices in the Western Cape. I'm based in the Somerset West office most of the time. If I'm not here, I'll be in Constantia or our Val de Vie office. If not there, then I also travel up to our Johannesburg and Durban office, and also to Mauritius as well, where we've got some clients. So happy to have a no-charge, complimentary initial discussion with my team. So please just reach out to us, and we'll do our best to assist you. Ladies and gentlemen, thank you very much for your time. I hope it's been useful. And if you've got any questions, don't hesitate to reach out to us. Take care.